It means higher costs and lower margins and possibly less demand. I mean, that's really what it means. I'm sure you've seen diesel prices hit $5. We haven't seen that since September of 2022. Back in 2022, fuel accounted for about 28% of a trucker's cost. It typically hovers around 20 to 25%. So, hopefully the prices that we're seeing now are temporary. Obviously, that all depends on what's going on in the Middle East, but it's definitely going to crimp margins and probably crimp demand just because, the longer that fuel is higher, folks out there will just have less money to spend on stuff.
What about the transition to electric vehicles for the trucking industry? Once upon a time, that was a big talking point, and it was kind of seen as, the future. Is that still the future for this industry?
It may be the future, but the future is nowhere near, especially for the over-the-road trucking companies. I mean, electric does make sense for certain applications, but those are few and far between. I think the technology has to get better. You have to remember that, trucks can only haul a certain amount of weight, and electric vehicles tend to add to a weight of a truck. So that means that's less stuff that they can haul. And then also you have the whole, the reality of some of these trucks are just going across the road, and they need to be sure that they can charge
Yeah.
their trucks, and the costs are just so much more expensive. So it's not like a shipper's going to, oh, I'm going to spend 50% more on rates just because you're driving an electric truck. That's just not going to happen.
So what are I mean, obviously fuel's a big issue for truckers here, but what's the demand side of the equation? What's it been over the last several months, and has it materially changed since the war in Iran began?
I mean, it's all about the consumer, really, and so I would say demand was tepid, but it was at least growing. What you have here is the inflationary pressure from higher fuel costs, the inflationary pressure for higher food costs, coupled with the fact that I think a lot of folks were hoping that interest rates would start coming down, and that seems to be slowing as well, and therefore that impacts end markets like housing and the automotive industry. So we're not we don't think that, oh, the consumer is going to totally pull back and this is going to drive us into a recession, but definitely the consumer is going to pull back and it is going to impact demand, and
Hmm.
people will have to shave off expectations for GDP the longer this conflict it goes on in the Middle East.
John Tucker mentioned two words, fuel surcharge. And I believe either FedEx or UPS at one point did tack that on for a while before removing it once oil prices came back down. Is that in our near future, Lee?
It could be. It depends on how high we go. And, a lot of other transportation companies, like trucking companies, whether it's truckload or less than truckload, and railroads, they do all have a fuel surcharge. And when fuel spikes quickly, like we've seen, the lag effect can be a drag on margins because they are paying for fuel today and then charging a surcharge from the past. In trucking, that delay or lag isn't that long. It's only a week, but for railroads, it could be 30 to 60 days. So that can impact, be a headwind for earnings going into the first and second quarter. But what I'd say, like, over time, it kind of plays out because when fuel prices decline quickly, it becomes a tailwind for earnings.